Canada's fixed mortgage rates are surging upwards, with bond yields jumping on news of the economy doing much better than what was expected, adding 54,000 jobs in November. And it's not just fixed rates. Economists are now expecting the Bank of Canada to hold off on any future cuts through 2026, just like how they kind of held off on cutting today, with some even expecting rate hikes in 2026. That sense of relief you might be feeling about the economy, though, it's a mirage. As we'll see today, the market is acting a tad hyperbolic, failing to account for the lag between economic policy and those changes trickling through the real economy. The mortgage pain from the highest interest rates we've seen in a generation, well, they haven't even fully hit yet. And the data that shows the worst is still to come has been right there for anyone willing to look. So, aside from the fact the Bank of Canada didn't cut rates today, let's start with the bigger news that has some people feeling optimistic. The November 2025 labor force survey. Stats Canada reported the national unemployment rate fell sharply to 6.5%, which is a big drop from 6.9% the month before. The economy added about 54,000 jobs, making the third month of gains after a rough patch earlier this year. But this is where the good news ends, especially for mortgage holders. Once you dig into the details, the story gets a bit darker. First, let's talk about the quality of the jobs. The gains were overwhelmingly driven by part-time work. Full-time jobs didn't drive growth. This isn't the sign of a robust economy. It's a sign of caution. And it's that kind of weakness that traps the Bank of Canada, making it difficult for them to cut rates and offer any relief to those who need it. Second, let's actually consider who's getting these jobs. A staggering 50,000 of these new jobs went to young Canadians between the age of 15 and 24. While great for youth employment, this is a notoriously volatile part of the labor market. The core aged workers between the ages of 25 and 54, who are most likely the ones paying mortgages, well, employment numbers barely budged. Third, that unemployment rate is misleading. A key reason it dropped so dramatically is that 26,000 people left the labor force entirely. The participation rate, the share of people working or looking for work, actually fell. When people stop looking for jobs, they aren't counted as unemployed, which makes the job market look healthier than it actually is. And the most telling sign? Cracks are appearing in the sectors that are most sensitive to economic trouble. While government-funded sectors like healthcare, social assistance are adding jobs, the private sector is showing serious distress. The wholesale and retail trade sector and the manufacturing sector both lost jobs. Sectors directly impacted by a slowdown in spending. These aren't just random blips, they're canaries in a proverbial coal mine, letting us know that the economy is too weak for homeowners to prosper, but not weak enough for the Bank of Canada to cut interest rates, as we saw today. So, if the job numbers are hiding this weakness, why aren't the mortgage rates coming down? The answer is a concept that's absolutely critical to understanding the pain ahead. Economic lag. Think of the economy as a massive ocean liner. When the captain turns the wheel, the ship doesn't turn on a dime. It keeps going for a while before slowly changing course. Economic policy works very similar. Central banks have told us for years that the effects of monetary policy, how interest rate changes trickle through the economy, aren't immediate. Economists generally estimate it takes about 18 to 24 months for the full impact of rate hikes to be felt in household spending and hiring. The aggressive rate hikes the Bank of Canada rolled out are only now really starting to show up. The full weight of those higher borrowing costs, well, they haven't really crushed all household budgets or business investment plans yet. But it is coming. We're living in that delay, the gap between the current turning of the wheel and millions of mortgages actually renewing at these higher interest rates. History has taught us this lesson again and again. Take the 2008 global financial crisis. The US officially entered a recession in December 2007. At that time, the unemployment rate was 5%. It took nearly a year for the full impact to detonate, with unemployment rates peaking at 10% almost 2 years later. It was the same story as the dot-com bubble bursting in the early 2000s. The stock market peaked in March of 2000, but the big waves of layoffs and economic pain didn't really hit in 2001 or 2002. In both cases, the headline numbers told you where the economy had been, but not where it was going. Today, we're seeing the exact same pattern. The positive job numbers of late 2025 are an echo of old momentum. They aren't a reflection of the new reality facing homeowners, the highest interest rates in generations, with the bulk of mortgage renewal pain still ahead. The second and arguably bigger storm on the horizon is the radical shift in global trade. This uncertainty is a key reason why the bond market is getting nervous, pushing up the fixed mortgage rates you'll face at renewal. For decades, Canada built its prosperity on stable trade with the United States. That foundation is now cracking. In a speech in September 2025, Bank of Canada Governor Tiff Macklem stated bluntly that Canada's economic prosperity depends on trade, and that trade is under attack. In its 2025 financial stability report, the Bank of Canada identified a long-lasting trade war as a major threat that could have severe economic consequences, potentially leading to a year-long recession. A trade-induced recession puts the Bank of Canada in an absolutely terrible position, making it even harder to provide rate relief through rate cuts. But the real danger is scheduled for July 1st of 2026, the joint review of the Canada-United States-Mexico Agreement, or CUSMA. This isn't just a routine check-in. The agreement has a review mechanism that makes this a very high-stakes moment. The three countries will decide whether to extend the pact. If they can't agree, it could trigger a process that puts the agreement's future in jeopardy. Analysts at the Center for Strategic and International Study, or CSIS, warned that what was once seen as a routine assessment is now likely to become a high-stakes negotiation. They note that every month of uncertainty acts as a silent tax on competitiveness, job creation, and trust. This uncertainty is a major factor for the bond market, which determines your fixed rate mortgages. The more risk and uncertainty there is in the economy, the higher the fixed rates go. This matters because North American trade is immense, with daily flows valued at around $3.6 billion. For Canada, which sends over 75% of its exports to North American partners, this disruption could be catastrophic. So when you put all the pieces together, the picture for mortgage holders becomes alarmingly clear. We have a job report that looks strong on the surface, but is weak underneath, trapping the Bank of Canada and preventing rate cuts on those variable rate mortgage holders that they're really hoping for. We have the well-known 18 to 24-month lag on monetary policy, meaning the full pain of the highest interest rates in decades is still working its way through our system, straight towards mortgage renewals next year. And we have the biggest threat of all, a fundamental reshaping of our most critical trading relationships, all leading to the high-stakes CUSMA review that is creating uncertainty in the bond market and pushing fixed rates higher and higher. The economic pain and mortgage pain may not have even started yet. What we're feeling now isn't the storm, it's the eerie calm before it. The next 12 to 18 months will likely reveal the true cost as millions of Canadians renew their mortgages. The lag will run out and the bills will start coming due. If you want to understand the real story behind these headlines and get ready for the turbulence ahead, make sure to hit that subscribe button. We break down these complex issues every single week so that you can make sense of what's coming and make smarter decisions. My name is Myles Nowik of the Nowik Mortgage Team, powered by Andy Mortgage. Thanks so much for tuning in. We'll catch you on the next one.